I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast, episode 23.
Bam! Holy cow.
That's, 23. And today we're going to hit, I think, a really good question we get a lot of times when we have buyers call us, right? And they ask us, what's better, an FHA or conventional loan?
Yeah, what do I go with, Tom? Ready?
Yeah.
Well, let's dig into it.
Right. I don't want FHA. It has mortgage insurance. You know, they have all that. I hear about all that mortgage insurance, and there's a lot of fear about FHA.
Yeah.
Especially around this FHA mortgage insurance.
Yeah.
Conventional loans just get, of course, all the good rap.
Yeah. Now, this may be diverting just a little bit, but also we get people that call about concerned about FHA because of the appraisals.
Right.
Appraisals are different.
Appraisals, yeah.
When it's minute difference between conventional. So people will call in. I think that was an old school issue that used to be.
Yeah.
But today, the FHA appraisals should be very standard, just like conventional.
Yeah. So. Conventional loans, conventional appraisals, I mean, they're identical. They're looking for health and safety issues. Now, peeling paint is one of those things that we probably see a little bit more on FHA. But if your house has crappy paint peeling off of it, that conventional loan appraiser may say, they want to paint it. So,
conventional or FHA?
Conventional. Yeah. So it's because it provides a safety issue that the home would mold, deterioration of the wood. Mm-hmm. Point is like that's probably the most common issue we see on FHA appraisals is peeling paint. But still, it's rare. It would be definitely a small minority of appraisals that come back with that item.
Right. Okay. But again, talking about FHA.
That's FHA. But again, that can happen on conventional appraisals too.
Yep.
Okay. So someone's calling us and they're saying, Eddie or Tom, I want to buy a house. Here's my credit score. Here's my down payment. Now, for the audience, let's just look at two comparisons. And we have actually a good web page. It's conventional versus FHA loans. It's under the loan programs tab. And for those of you on YouTube following us, just take a look at that that page, and we'll bring it up here on the YouTube. So anyway, the first scenario that we actually show is what we would be looking at when we're talking to a borrower with excellent credit. Okay, borrower calls us, and to make things apples to apples, trying to keep it as close as possible as an apples to apples comparison. Mm-hmm. It looks at a comparison with someone with a 760 plus credit score, so excellent credit. Mm-hmm. How does FHA stack up against the conventional loan? And so the loan, this hypothetical sales price is $300,000. It's 5% down on each. Okay, so this is just the hypothetical scenario. Technically, FHA, right? We actually can put we have a 3% down program on that, and FHA has a 3.5% minimum down. But just to make things equal, we're just saying 5% so people can see. What they'll notice is that Tommy, maybe you can talk here about the interest rate differences and go down maybe on what are the big differences and what's kind of the overall conclusion.
Yeah, I mean, and the fact that you started off with the excellent credit scores, we can go through the comparison, but really the biggest difference between FHA and in conventional really comes down to credit score, and it comes down to credit event. So when you are our excellent credit score borrower with no credit event, the conventional loan hands down
is like a foreclosure or short sale or something, bankruptcy.
Exactly. Mm-hmm. So if you don't have any of those, which if you have good credit, typically, you're going to be with, outside of that, grace period or seasoning that's required for those credit events. But typically, but as we are talking conventional, good credit, lack of credit events, you're going to go conventional. And if you look here at this sheet that we put together, it lays it out. The biggest difference is going to be the interest rate. The interest rate on the FHA is going to be 3.25 versus on the conventional it's going to be 3.875. I don't know if we want to get into the whole, upfront private mortgage insurance factor, but I usually like to talk about the interest rate in the same breath as I talk about the private mortgage insurance monthly payment.
Yeah, I would say that we can talk about that. I mean, the FHA product does have upfront mortgage insurance. And if you're watching this online, you can actually see that in this scenario, it's about $4,900. Okay, so that's the bad thing, right? That's a con. The great thing about conventional loans, it doesn't have upfront mortgage insurance.
Right. And it can't be waived on FHA, regardless if you put 90% down.
Mm-hmm.
That does not change. It comes down because that upfront mortgage insurance is only based on the loan amount, but nonetheless you'd still have it.
That's right. And with FHA loans, if you put less than 10% down, the mortgage insurance is going to be on the loan forever. So when you look at mortgage insurance, like the monthly payment mortgage insurance, that is something that's stuck on the loan forever. So for the life of the loan.
And if you do put more than 10% down,
then it's eligible to be removed after 11 years, which is still a dang long time.
11 whopping years, when the average person refinances after 7 years or within 7 years.
Right.
So chances are, you're going to end up refinancing that prior to when it would drop off, but just something important for people to know.
Yeah. So when you look at the side-by-side, the FHA loan on a $300,000 sales price, 5% down, the interest rates, the total payment on the conventional loan is $38 cheaper.
Mm-hmm.
Okay. So the FHA loan is $38, more expensive. So one of the things I would point out in this scenario is obviously conventional financing is a better deal. It's a little lower payment.
Mm-hmm.
But also there's in this particular case, there's $85 of mortgage insurance a month. That's eligible to be removed. Okay, so on a conventional loan, not only are you saving $38 now, in the future that will drop off. We won't really get into how that mechanism, how that works yet, but we'll handle that in another podcast.
Right.
The $85 will fall off.
Right.
And
you don't have the upfront mortgage insurance payment.
You don't have upfront. So really your monthly savings can go to $120 or so.
Mm-hmm. So the three big reasons why conventional is better is right off the bat, lower monthly payment. Number two, the mortgage insurance will drop after, that loan to value is at or about 80%. It's usually between 78 and 80.
Yeah.
There's rules. And then lastly, your loan amount is not increased by the amount of the upfront mortgage insurance premium like it is on the FHA. So three big no-brainers why conventional is the way to go.
Okay. So, and I would say we can look at this comparison number two, someone who has a credit score of 660.
Okay.
Which we would call below average.
Yeah, boy, it sure seems like a lot of people are in that high 600 range. But yeah, I guess that's probably a fair statement. It is below average, but still not a terrible score. 660, 680. We read a lot of loans that do FHA, and thank goodness for FHA because there's a lot of people in that segment. But what we just got done talking about was that perfect credit. This is again 100 points less at 660. So okay, sorry, Ed, you keep going.
No, okay. So it's the same worksheet. It shows a $300,000 sales price, 5% down. What you'll notice is the interest rate on FHA is the same as before in the other scenario. So whether you have great credit or not, the interest rates are going to be basically identical. So this shows 3.25% on the interest rate on the FHA.
Mm-hmm. And what I was going to say was FHA really, anything above that 660 mark 660.
Yeah, right.
We'll treat credit or we'll treat the interest rate the same based upon your, regardless of your credit. Anything below that, there's a little bit of a variance, but not much.
Yeah.
Not nearly as sensitive as.
It could be like a quarter of a point or something like that. If you have a 640, a 625. But but conventional financing is extremely sensitive to your credit scores.
Holy buckets. Look at that rate.
So if you have a 760 score, it was 3.875.
3.875.
If you have a 660, it goes up to 4.99, so over a full percentage point. So,
Holy cow. And people may ask, why is conventional so sensitive to that? Why are they not like FHA? I think the simple answer is FHA is built with that upfront mortgage insurance to keep interest rates low.
Yeah, I would say it's because Fannie and Freddie they're the conventional. How about conventional financing has private mortgage insurance, so it's in the private industry of mortgage insurance. Those are private companies held, whereas FHA has the government insurance through HUD, and the government's going to have the higher tolerance for risk. The private sector is going to have lower tolerance.
Good. Okay. So again, we're talking about 660 credit scores ish or below. All of a sudden, FHA is looking really good compared to conventional.
Yes, for sure. In this scenario, what you'll notice is it doesn't matter if FHA has that upfront mortgage insurance. It doesn't matter if at that at all. The payment on the FHA is $373 less.
Holy cow!
And I I did the math here on, even though the FHA loan has upfront mortgage insurance of $4,900, if you take the $4,900 and divide it by the $373 of monthly savings, it would take you just a little over 13 months to break even. So very quick. Now, the conventional loan does have $308 of mortgage insurance. So it's very high.
Right.
Even if that goes away, in the future, because that will be eligible, you will still be in a position where you're paying more money.
I'm actually working with a borrower right now. They have a credit score of 634. One of the spouses has 634. The other has 720. Because we have to use both their incomes, we actually have to go to that lower score, 634.
Right.
And one of the spouses does not want conventional. Does not want FHA. There's just a stigma. Tom, we just don't want that insurance because we're putting 20% down. Doesn't that help us? And after you run the numbers, even with 20% down, with no mortgage insurance on the conventional, the FHA was still like $40 cheaper.
Yeah.
And it was just really difficult for this borrower to come to the conclusion that FHA was the plan or was the better play. But they finally did, become resolved to understand, yes, FHA is the plan. And so I think what we're going to do is we're going to lock them into an FHA loan, get them better pricing than conventional. And over the next year and a half, they're going to work on their credit to where the one spouse can get her credit up to, that 700, 720 mark. That's when the conventional starts to like you. And then we'll just do a refi. And maybe by then they'll need some cash out or whatnot, so we can work in a couple of different reasons as to why we would refi. But they love that plan.
Right.
So it's really good. It's really counterintuitive. You just don't think, I got 20% down. We're going to go forward. Well, what did we say when we started the podcast? For a credit score or a credit event, FHA is the way to go, regardless of how much money you have.
That's right. Good point. Very good point. Again, we were showing examples just with 5% down, but just as Tom said, even if you're putting 20, 30% down, if you have your credit scores, are lower and you have that credit event, FHA is going to beat that conventional every time.
Yeah.
So be sure to call us, email us anytime, and ask us questions regarding these, these programs. We'll be happy to help.
Yeah, we're here.
All right. Well, I hope this was at least something that people enjoyed listening to if you are in the market looking for a loan. So everyone, have a good rest of your week. Tom, I think we're good.
Yeah, I think we're good. Let's call it a day.
All right. Time to go home.
All right. We'll see you, folks.
See you, everyone. Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to tom@azmortgagebrothers.com or yours truly at eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.